really try to be able to be open and communicative to our investors. We want to make sure they're comfortable and they know what's happening at all times. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and today we're going to talk a bit about syndications. But first, I did a LinkedIn post the other day, and we finally have a supply that is, or sorry, we finally have demand that is outpacing supply. So this is the first quarter, which it's actually Q4 of 2024, because of course all data is back looking, but that's the first time since 2022 that we have actually had demand outpace supply. So, and this is nationwide, of course. And so supply, we've had a ton of building that has been going on, and we've had a ton of supply hitting the market. And 2025 is actually going to be another banner year for supply, most of it coming in the first half of the year. And what you're going to see is kind of the same as what we've been seeing, right? So the southern markets, the Sun Belt markets, they're going to see the most amount of supply and oversupply hitting the market. So, your Austins and your Dallases and Phoenix and Charlotte and Atlanta and so on. But there's a couple of other markets, Nashville, which is, I guess, technically south, but not like deep south. And then Denver is up there in Salt Lake. So those are a couple of other markets that are seeing an excessive amount of supply. But they're also, all these markets are seeing a really good amount of demand. And by the end of 2025, you're going to see, I think, all markets, unless, of course, there's plenty of things that could happen, but unless something happens, you're going to see all these markets that are going to have more demand than supply coming on. Now, it doesn't mean that some of these high supply markets, all of a sudden, the occupancy rates are going to be 95% plus, and rents are going to start to skyrocket. It's not instantaneous, right? Don't forget, real estate is very slow moving. So it will take a while for those markets to catch up. And so I would say there's going to be some of the markets that have a little less supply and a lot of growth. They'll kind of catch that in 2025, where they'll start to see the vacancy rates improve, significantly, and probably start to see rents go up by the end of 2025. But again, like, the rents are going to go up, but it's not like they go from negative 5% to all of a sudden positive 5% overnight. So, a lot of these markets are going to still see negative rents overall in 2025. And there's going to be quite a few, some of the Southeast specifically, and Austin. Austin is the outlier too. And actually, I think Nashville, Austin, and Charlotte are the top three for percentage of supply coming on the market, which those three plus a handful of other ones too. It's not just those three, it's a handful of other ones that probably won't see rent growth until 2026 and maybe even 2027. Might take them till 2027. Midwest, Northeast, they're still seeing rent growth. There hasn't been the supply, so everything's good there. All right, on to the topic. I want to talk about syndication and just some things that I have, heard from just conversations, not only just over the years, but recently. So not too long ago, I was talking with a prospective investor who's he wasn't really sold on investing in a syndication. His main pushback was, well, I want to have control. Like, I really have a tough time giving up the control on the real estate. And I said, well, I asked him, I said, do you have any money invested in the stock market? And he said, well, yeah, of course. I said, do you have any money invested in crypto? He said, well, yeah. And I said, are you in control of those? And he's like, oh, no, I'm not. So I said, so why are you okay with investing in other businesses that you have no control over? You're not investing in Amazon and then calling up Jeff Bezos and telling him what to do. And you're not calling the shots, right? You're just not. You're not the CEO of Amazon or Walmart or anything that you're investing in. And with the crypto market, I mean, frankly, it's just a complete, like, you have no control over that, like zero control. And I said, are you picking your stocks yourself, or are you relying on a financial advisor? He said, well, actually, for the most part, relying on a financial advisor. I picked my crypto. I said, well, okay, yeah, that's fine, but you don't even pick your stocks. So not only are you not in control with the companies you're investing in, but you're not even in control with the stock that you're picking. And with passive investing in real estate, you're going to be in control of the companies you're investing in. You certainly can't control the outcome, but you get to decide what properties that you're going to invest in. You get to decide what sponsors you're going to invest in, all that kind of stuff. So you have I think if you have any of that pushback from a potential investor, or if you're a potential investor listening to that, and that's been your thought, like, I really want to control this real estate, I have a tough time giving that up. My question would be, why? You're not the CEO, you're not even an employee, you're just a shareholder of these stocks, and you're okay with that. It's because that's what you're used to. But for some reason, you've got this fantasy, this idea, this belief that you need to be in control of the real estate. And that, again, doesn't make sense. Um, Now, I'm okay with it. I certainly don't want to tell you you shouldn't be, but if you are betting on the sponsor, you are relying on an expert. It's like a farmer. It's like me going to a farmer and say, "Hey, farmer, look, I know you farm, but I'm just gonna, I'm gonna, I don't trust you. I gotta control my own farm. So I'm gonna buy my own pigs and cows and, you know, plants and all that kind of stuff. I'm gonna do it because I don't believe you can do it better than me. Uh, you know, like, you'd never say that, right? Now you might do it because you enjoy it, like it's a hobby for you, and that's okay if that's what you want with real estate. But you know, you're not the expert. This isn't what you do day to day. Maybe you say, well, I am. Okay, that's fine. Then do it yourself. Okay. So I get asked quite a bit what an accredited investor is. So I'm going to go through that real quick. And again, I'm just going to pick out some stuff that I hear from, and people talk to me about. So accredited investor, real quick, because I know most of you probably listening know what it is. Net worth of $1 million. That excludes your primary residence. You earn $200,000 as an individual, or if you file jointly with like a spouse, it's $300,000. And it's for the past 2 years, and you're continuing to expect that. So I think that's really important to know. There's not a certificate, like, especially if you're going to 506B, like, you just check a box. It's as simple as that. Now, it doesn't mean you can lie about it, but you don't have to have both a net worth of 1 million and earn the 200 or $300,000. You have to have one or the other. If you're going to invest in a 506C, which you have to be accredited, then you do have to go through a process, but it's super simple. There's third-party verification out there where you just send them your W-2 or you send them your financial statements, and they go through and they approve you pretty quickly. You can get a letter from your CPA if they're willing to do that. So there's a couple different ways. There's also, if you hold your FINRA Series 7, 62, 65, your financial professional certification, you can qualify as well. So, and as far as like being non-accredited, if you're like, hey, well, I don't qualify, that means I can't invest in these deals. Well, yes and no. 506B, you can invest in as long as you're sophisticated and you have a pre-existing relationship. So sophisticated means you really understand what you're doing. Like you can prove that, hey, I know what I'm doing. So you've either, bought some real estate yourself and you're financially savvy, like you understand it, you get it, and you have a pre-existing relationship. So, if you're interested in syndications, of course, uh, you got to get to know the sponsors and you can't just go and invest. Um, all right. So I get asked too, like, hey, like, why? What's the benefits? What's the benefits of passive investing? And I've talked about this a lot on the show, but I'm going to go through some of the things that I put down there. And again, this is great if you're looking to raise capital. It's great if you're a potential investor. Um, I think it's really important to understand. And by the way, like I would say, even if you're flipping houses or buying your own real estate as rentals, I would still highly suggest you look at diversifying and potentially investing in a syndication. Now, again, you don't have to, but I think it's a great tool for you to have a little bit of passive income. Um, so first of all, minimal time commitment, right? In a syndication deal, you invest your capital, you don't have to do anything else, right? There's no need to handle the tenants or the maintenance or the issues, stuff like that. So if you're busy, especially a busy professional, business owner, husband, wife, uh, kids, all that kind of stuff. Like you don't want to spend time with the tenants, the toilets, trash, the termites, all that kind of stuff, dealing with the headaches. Hey, it's pretty awesome to be able to invest passively. Diversification. Look, financial planners always tell you to diversify, diversify, diversify. Yet they don't put you into something like this. They put you into stocks, bonds, and mutual funds, but they don't put you into this. So it gives you diversification outside of kind of the traditional market. Doesn't ebb and flow the exact same as the traditional market. Works a lot differently. So pretty nice product to get into. Of course, tax benefits. Like here's the cool thing. Now, everybody's financial and tax situation is different. So I can't tell you what you can take advantage of and what you can't, but you get the exact same tax benefits like you're directly owning it. And the cool thing with bigger assets is we can actually afford to, makes a lot of sense, to run a cost segregation study and do bonus depreciation. And with like a single family rental, probably most cases, it doesn't make sense to do a cost segregation study, which essentially just accelerates our depreciation. So we can take more upfront. So if you have a tax issue, you're going to make a lot of money, you can qualify and you can take advantage of it. You can really get some powerful write-offs in year one and year two by investing in these syndications. Of course, consult with your CPA to make sure you can actually take advantage and you know how it's going to benefit you. Um, Limited liability, right? I get asked this question too, is like, hey, if I invest in this deal and what happens? Like if the tenant slips and falls, am I going to be like, am I going to be dragged into that lawsuit? The answer is no. Now, will it affect you financially? Sure. Like if the tenant slips and falls and it's a lawsuit and they find it's you're liable, the LLC is liable for damages and the insurance company won't cover it and it causes a financial burden on the property. Sure, that's your money, but that's just like if any company gets sued. If Walmart example gets sued, you don't have to go show up to court, just like in a syndication. You're not going to have to go show up to court. But, you know, could it affect the stock price? Yeah, absolutely. Um, the same thing with the loan. Like you're not signing on the loan. Where if you buy this piece of real estate yourself, you're going to put a personal guarantee on it. Look, I still have, like I counted the other day, I think it was 17. I still have 17 um, rental properties, 1 to 4 family rental properties. Maybe it was a little bit more. Um, I personally guaranteed all those, right? I'm tied to those loans. If anything goes wrong, now I've got a ton of equity, so I'm in a pretty good position with those. But if I wasn't, if anything goes wrong, I'm tied to those properties. If somebody does slip and fall, I'm tied. My personal name, they could potentially pierce that corporate veil and get to me. Like I still have exposure. Um, in a syndication, you don't really have that exposure. So I get asked, like, so how does this work? This syndication process work? So I'm going to peek behind the curtain of how we do it at Endurance Capital. So when we have, I'll take you from the start. So first of all, building the investor relationships is really important. So we are obviously, this podcast is for a reason, right? It helps build relationships without me meeting people one on one. But we do one on one. I try to meet people for coffee, do Zoom calls, do phone calls, and always be an open book and be willing to meet with people. That's actually one of the most enjoyable parts of what I do. I love to go get coffee and meet people. Actually, I don't drink coffee, but I love to go meet people at a coffee house and talk real estate. I love talking through what we do and just shaking hands and meeting people. Um, so that's a big part. But social media, our newsletter, all that kind of stuff is, educating investors and getting in front of them and getting them to get to know us. Once we have a deal, we got a deal, and we say, hey, we're going to syndicate this deal. So I put this deal under contract, and we do our due diligence. So we put a deal under contract, and right away, as soon as we can, we kind of start the process of getting our slide deck going. So we're trying to get the pictures taken. We're trying to get the financials and the underwriting tightened up. We're doing our due diligence. We're doing all that as quickly as possible, and so that way we can get the slide deck going, and we can set up our webinar. So we're going to set up our webinar, decide the time and the date. We're going to do it as quickly as possible. Again, after we get this under contract. Usually, when we put a property under uh, LOI, letter of intent, it's going to be 2 to 3 weeks before we actually have it under contract. We go back and forth with the attorneys quite a few times. So it's usually maybe not 2 to 3 weeks is probably a long period of time. That does happen, but let's call it 7 to 14 days, somewhere around there is pretty standard. Um, so we have some time where we can kind of get some of that ball rolling before it's even under the contract, before the clock starts ticking. Because once we put it under contract, we've usually got about 75 to 90 days to be able to close. So it goes pretty quickly, especially if we have to raise a lot of money. If we're talking about, where's it, 10, $15 million, like, man, we got to raise that quickly. We haven't pre-raised anything. We've built the relationships, we got our investors ready to go, but we haven't pre-raised that money. So once we have the slide deck ready, we've done our due diligence, we're ready to send this out to investors. We're going to send a couple of emails out to our investors saying, hey, we got this webinar coming up. And we do the webinar, host the webinar, talk to our investors about the deal, what we like about it, why it's a good investment opportunity. And then we open it up for investors to start making commitments. And from there, it's phone calls, it's emails, it's text messages, it's getting in front of investors, making sure they understand the deal and why it's valuable. We're typically filling up fairly quickly, but some deals, the bigger the deals, or if we've done several back to back to back, we might have to make some more phone calls. We might have to get some more interaction going. We're always asking for referrals from our investors. Usually, we're trying to, I shouldn't say it, we're usually typically, especially if we're doing a 506B, we're asking for referrals prior to the offering, because we do have to get to know the new investors, right? We have to get to know them all. But that goes out there, and then once it gets filled up, then obviously the subscription gets signed and the wires go in and we close on the property, and then we're off to the races. Um, so that kind of gives you a peek behind kind of the curtain. And then once we're up and running, we're sending our investors a monthly update every single month. We're telling them what's going on with the property. We're sending our financial statements, our T12, showing them what's going on, talking about the financials, talking about what we're doing. If we're doing a renovation, we're talking about how many units we're renovating and what's happening there. And we sometimes offer some live tours depending on what's going on with the property, and really try to be able to be open and communicative to our investors. We want to make sure they're comfortable and they know what's happening at all times. And that's really important. So I think monthly communication is really huge. And then we're set up on quarterly distributions for most of our deals. So we're sending out distributions every quarter, based on the cash flow of the deal and what's happening there. And there's typically a pref, so like a 7% pref, meaning the investors get the first 7% of all profits on their dollar. So, for instance, if you invested $100,000, if we cash flow $5,000 in year one, you'd get all $5,000. Sorry, 5%. I mean, you'd get all $5,000, all 5% of your 100,000. Now, well, you didn't make your 7%, so that just accrues. And so in year two, let's say we make 7%, okay, um, you would get $7,000. You get your 7%. That would cover the pref that year. In year three, let's just say we cash flowed 9%. Okay, well, still the limited partners would get 100% of profit because you'd get the 7% pref, right? And then there would be a 2% catch up because year one, remember, we only paid 5%. So you're getting that 2% catch up. Then in year four, let's say we make 9% again. Now, since we've already paid all of our pref, now is where the split would come in. So investors would get the 7 pref if there was a 7 pref, and then we would split, let's call it 70-30. 70 goes to the investor, the limited partner, and 30% goes to the general partner. So instead of the full 9%, you'd get the 7%, and then we'd split the remaining 2%. So you'd get a total of what's that? I don't I don't know. Do the math. You get some money. Um, and then you keep on going, right? And so it makes 10%, same thing. And then eventually, it sells and you get your profit, you get the split at the end. The goal for us, the goal is typically, we have a perspectives and we're saying where the financials are, but typically our goal is to, kind of what we say, tell investors is, look, we're trying to double your money in about 5 to 7 years. And that's kind of what we're trying to achieve. Of course, that's a goal. It's not a guarantee. There's no guarantees in any investment. But that's kind of, where we set our sights for. Um, One of the other things, so as a limited partner or a general partner, as a limited partner, general partner, you really want to understand the there's I think there's a couple big things when we're looking at these deals. So first off, understand the fees that are charged by the GP. Fee heavy GPs, in my opinion, that's a bad way to go. So we charge an acquisition fee, but it's not massive, right? So a 1 to 3% acquisition fee, meaning you're getting paid for the purchase. That's okay because it covers a lot of upfront expenses, and GPs certainly have to make some money, but you want to make sure that those are limited. You don't want a huge acquisition fee. And then we only have a one more fee that's usually about 1.5% asset management fee, and that's based on the gross collected revenue, and that's going to pay for our asset manager simply. That's it. That we don't charge any other fees. Everything else is performance based. We don't get paid until the LPs get paid, get their money back. Like we're typically not getting paid till the end, till this deal performs in the end. And I think that's really healthy. I think that's super important as you're looking at deals and looking at the fee structures. Now you can decide what you like and what you don't like, but I don't like upfront there just being a ton of fees. I just don't think that's healthy for you as a limited partner. The other thing that I think is really important is the kind of the whole team, what's going on, like who's in front of the investors, who's behind the scenes, what kind of experience do they have, right? Who are the employees? Is it in-house? Is it third party? Why do we trust the third party? If it's third party, why do we trust the in-house, quite frankly, if it's in-house? So I think it's super important to understand what the team is, what their experience is, who's making that up. So that's another big thing. Um, it's really important to understand the experience that the sponsor has with both the strategy and the market. So we're talking strategy as like, hey, I'm doing a value add, multifamily value add in the Twin Cities. So for instance, we're doing a larger multifamily value add, big value add in the Twin Cities. What's our experience with that? What's our team's experience with that? Look, we partnered with a guy who has done a ton of these, and he's been extremely successful doing massive value add. So like we're putting 40 grand a door into it. He's done deals where he's put 40, 50 grand a door into these deals, and he's been super successful. He's got them done in crazy quick times. They renovated a 700 unit apartment complex in 18 months. That's the person I trust. So he's going to be our project manager. Trust that he can get that done. We've had experience doing a lot of value adds ourselves. It's in our home market. We know the market extremely well. We've got a deep understanding of the market. We've been in business for a long time and have done plenty of deals that fit this bill. And so we feel very confident. So why can we execute our business plan? Do we have any kind of track record? And then track record's really important too, when we're talking even deeper understanding, like how many deals have they bought? How many deals have they sold? If they haven't sold a lot of deals, what are their current deals doing? How many refinances have they done? What's their cash on cash return for their long-term hold deals? Find out what's going on with their current portfolio, not just the good ones, everything. Make sure you understand that. The next thing is alignment. I think it's really important to make sure you're aligning, um, the GPs are aligning with you, meaning do they have some money into this deal? We typically invest 5 to 10% of the equity. Like, are they willing to sign on the loan, or do they have to bring in somebody else to sign? Will they sign a personal guarantee? We're signing a personal guarantee on this loan. Like, that's a big deal. So I think that's really important. And yeah, that was kind of it. So those are kind of the big, I guess five really. So experience with the strategy in the market, the leadership team, the track record, the alignment, the reporting, and the fees. So I guess that's six. All right. Man, there's a lot more, but I don't want to keep on going on this topic. I'll probably continue to talk about it, but I think it's really important. Actually, I'm going to cover one more thing. I think it's really important as we dig into deals. So I'm going to just name these things off. I won't go into extreme detail on them, but I think there's really uh, kind of 4 or 5 main things. So five, we'll call it five. So first of all, when you're digging into a deal, we have to understand the location. Understand that the better class neighborhoods are less risk, and the lower class neighborhoods are more risk. And I don't care who tells you otherwise. It's just the truth. Like A class buildings in A class neighborhoods have less risk than C class buildings in C class neighborhoods. So is it a good location with growing population, low crime, good access to the property? You know, what is it? What is this type of building? And then what is this operator sponsor? What kind of experience do they have in those types of locations? Financing, this one's huge. I've talked about this a lot. Look, higher risk is going to be floating rate bridge debt. I don't care if they got a rate cap or no rate cap. Well, no rate cap is even higher risk than a rate cap, but floating rate bridge debt is uh, a lot of risk compared to a fixed rate debt. The lower the LTV, the better. The higher the debt service coverage ratio, the better. And not having mezzanine or pref equity on top of the debt is better as well. So if we add mezzanine debt or pref on top of like a bridge loan, forget it. Like don't even touch it. Like in my opinion, that's a crazy deal to even think about getting into. Fixed rate debt, low LTV, high debt service coverage ratio. That's a dream, right? That's low risk deal that I think any LP should be excited to look at. Cash flow. I like having cash flow, real cash flow, not just cash flow based where the LP is paying you out of the GP is paying you out of reserves. Real cash flow coming in the door. Does the property actually work? And then just understanding the underwriting metrics, right? Cap rate on exit. Is it equal to or greater than the current market, not what they're buying the property at, the current market, rent comparables. Can we actually achieve the rents we're trying to get? reserves. Do we have big reserves? Like I want 4 months if it's stabilized, 6 months if it's a really light value add, 9 months if it's a moderate value add. I want 10 to 12 plus months if it's a heavy value add. Reserves, what kills more businesses than anything is not enough cash. So make sure you have reserves. And then the last thing I want to do is make sure there's some nice stress testing going on. Like what's our break even if the occupancy drops and interest rates go up? Like what happens? What happens if sales cap rates expand? Length of investment has to go up, all those types of things. So all right, that was a lot. And so I want to just wrap up by saying there's a lot to dig into. We've got a ton of information on our website, endurancecapital.com. There's a ton of information kind of out there all over the internet. Bigger Pockets is a great resource. Do your due diligence, continue to learn and understand whether you're going to be the one offering investors a deal and saying, hey, I'm going to raise for investors. That's super important that you understand all the little nuances, everything that's out there. Make sure that you understand how the investors are going to get paid, why your deal makes a lot of sense, and why everything and how everything works together. If you're an LP, again, just make sure you're being very well educated, because there's a lot of bad deals out there, in my opinion, that people shouldn't be getting into, that they do get into because they're excited about the shiny little numbers out there. They're excited that, oh, this person's been great. And just make sure you truly understand what you're getting yourself into, and you're going to be a lot better off for it. So that's all I got for today. You make it a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.